At $1.87 per share, this company is trying to solve one of the biggest inefficiencies in the digital economy: how advertisers actually understand intent. Not clicks. Not demographics. Intent. And while most AI headlines focus on chips and chatbots, this firm has built a machine learning engine designed to predict what someone wants before they ever type it into a search bar. Now here's the disconnect. The global digital advertising market is worth hundreds of billions of dollars annually. AI-driven targeting is becoming the backbone of that system. Yet this company trades under $2, with a valuation that suggests it's barely part of the conversation. A few years ago, the stock traded significantly higher. Since then, it's compressed alongside small-cap tech. But the underlying technology didn't disappear. If anything, the AI layer became more relevant. So what exactly does it build? At the core is an artificial intelligence platform designed to identify what it calls intent signals. Instead of tracking users across the web using cookies, a method that is rapidly losing effectiveness as privacy rules tighten, this system analyzes contextual behavior patterns in real time. It evaluates page content, user engagement patterns, semantic relationships between topics, and predictive modeling to determine what a person is likely to be interested in next. In practical terms, that means when someone reads about electric vehicles, home refinancing, or fitness programs, the system isn't just categorizing the page. It's mapping probabilistic buying intent. And then it delivers targeted ads based on that forward-looking prediction rather than backward-looking tracking. That matters because third-party cookies are being phased out. Major browsers have restricted them. Regulators are tightening data privacy standards. The old model of surveillance-style ad tracking is fading. But brands still need performance. And this platform positions itself as a privacy-aligned AI alternative. It's deployed through programmatic advertising exchanges, meaning it integrates directly into the infrastructure that powers real-time ad bidding across thousands of websites. Agencies and brands plug into it to improve conversion efficiency without violating tightening data rules. Which raises the obvious question. If AI-driven intent targeting is increasingly critical in a privacy-first world, why is this company still priced like a speculative micro-cap? There's a reason the market hasn't rewarded it yet. Scale. In digital advertising, giants dominate. Platforms like Google and Meta control enormous ecosystems. Smaller players must prove differentiation, not just participation. Revenue volatility, historical losses, and the perception that ad tech is cyclical have kept investors cautious. But zoom out for a moment. The advertising industry is shifting from identity-based targeting to contextual and predictive modeling. That shift is structural, not cyclical. And AI models trained on behavioral semantics, rather than personal identifiers, may be better positioned as regulations tighten further. This company's business model revolves around licensing its AI engine to advertisers and agencies. It earns revenue by placing ads to its platform and optimizing campaign performance. The better the predictive accuracy, the higher the conversion rates. The higher the conversion rates, the more advertisers are willing to spend. That creates a feedback loop. Performance drives spend. Spend drives data. Data improves the model. But here's where tension reappears. Because it operates at a smaller scale than dominant ad platforms, revenue growth must outpace skepticism. Investors need proof that this isn't just another ad tech vendor competing on thin margins, but rather a differentiated AI layer embedded in the infrastructure. Recent operational updates have emphasized improvements in gross margins and the expansion of proprietary data modeling. The company has highlighted stronger campaign performance metrics compared to traditional targeting approaches. That suggests the technology is not theoretical, it's being used in live advertising environments. Yet the stock still trades under $2. Which brings us to the reveal. The company is Inuvo Incorporated, ticker symbol INUV. Current share price, $1.87. Inuvo positions itself as an AI-powered advertising technology company focused on predictive intent modeling. Its flagship platform, often referred to as an intent key engine, is designed to operate without relying on third-party cookies while still delivering targeted advertising results. So why hasn't the market priced it like an AI infrastructure player? Part of the answer lies in size. Smaller companies often lack institutional coverage. Limited analyst visibility means fewer large funds accumulate positions. Liquidity remains thin. And in volatile markets, small-cap tech names tend to get discounted more aggressively than mega-cap peers. There's also execution risk. Ad tech is competitive. Performance must consistently outperform alternatives. If campaign results lag or advertisers consolidate budgets elsewhere, growth stalls. But here's the counterbalance. As privacy restrictions expand and cookie deprecation becomes permanent, brands will be forced to adopt alternative targeting methods. AI-driven contextual modeling isn't optional, it becomes necessary. If Inuvo's technology proves measurably effective, the addressable market is not niche. It's enormous. The timeline matters. Between now and 2026, digital advertising infrastructure will continue adapting to regulatory pressure and AI integration. If Inuvo can demonstrate consistent revenue growth, margin expansion, and differentiated performance metrics, the valuation conversation could shift from survival to scalability. That doesn't guarantee repricing. Small companies must execute nearly flawlessly to change perception. But valuation asymmetry exists when a company operates in a structurally growing AI segment, while trading at levels typically reserved for businesses in decline. And that's the tension you need to weigh. At $1.87, the market is signaling caution. It's pricing in uncertainty, competitive pressure, and scale limitations. But the underlying thesis revolves around predictive AI applied to one of the largest recurring industries in the world. If AI continues moving beyond chat interfaces into real economic infrastructure, advertising, logistics, healthcare optimization, then companies embedding machine learning directly into revenue-generating systems may gain strategic importance. Still, risk remains real. Revenue concentration, dependence on advertising budgets, economic slowdowns, or failure to achieve consistent profitability could all suppress the stock. Dilution risk also exists for small-cap firms seeking capital for expansion. So this becomes a question of trajectory versus perception. Is Inuvo simply another micro-cap ad tech company struggling for relevance? Or is it an early-stage AI infrastructure layer positioned at the intersection of privacy regulation and predictive analytics? The answer will likely emerge over the next several years, not weeks. For now, the market assigns it a sub-$2 price tag. Whether that represents justified caution or overlooked asymmetry depends on execution, adoption, and the accelerating shift toward AI-driven intent modeling in a post-cookie world. And that's the real evaluation behind the title.